Believe it or not, there are still good stocks to buy in 2025 in this overvalued market. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véro, and it is the first podcast of the year that we are recording in January after like good 2 weeks of vacation. So, pardon us if we digress and if we talk about plenty of other stuff during the podcast. I don't know what it's going to look like, but I can feel the energy right now. How do you feel, Véro?
Well, I'm doing good, but like you've mentioned, it's been like 2-3 weeks that I haven't spoken in English much. So I might I might have like some French words coming up. Okay, so listeners, at the end of 2024, we invited you to review your portfolio and prepare for this new year. We even did a podcast series on how to invest in 2025 that you can retrieve at thedividendguyblog.com/208. Today, to help you achieve your goals, we will give you some of our best stocks to buy. We will cover our top 3 US dividend stocks and their industry. And next week, we'll hit the Canadian ones. Don't miss it. Tap the subscribe button underneath our podcast logo now. And also, before we start, you should not consider the stocks mentioned today as buy or sell recommendations. You must always proceed with your due diligence before any transaction. All right, Mike, let's do this. The first company I'd like you to discuss is in the healthcare sector, specifically the healthcare plans industry. What's to remember about this subsector?
So first, for our dear friend Canadians, the healthcare system in the US is quite complex. Actually, I would be curious to know how far most American knows about how it works, because every single time I have to kind of like circle back and do a little bit of reading before I start talking about it. It's just so unusual for us Canadians that I guess this is why I find it complex. But long story short, you have companies called pharmacy benefit managers, so PBNs in short. Those companies are like CVS, Elevance Health, United Healthcare Group, for example. What they do is they manage and they offer the pharmacy benefits. So literally, like if you are an employee, you need healthcare coverage that is usually provided by your employer. So those companies will offer the insurance, but will also manage all the prescription, the visit to the pharmacy, and all the services provided to the employees. So it's kind of like a vertically integrated system where they offer the service to both the employer and the employees, and of course, they're making some money along the way. It's kind of like an oligopoly right now because most of those players are very large. They have a vast network. They usually cover many states, and there's a lot of pressure on them after the election, as the Trump administration has been quite clear that they're going to go after healthcare costs. And of course, that probably means to ask the PBMs to do a little bit more for the employers and for the employees. So it's going to be
Hmm.
an interesting story to follow in 2025.
So would you say that this industry will perform overall this year, or will it depend on each company?
I love to say it depends, right? Jokes aside, I think that because there are a lot of uncertainties, it's probably a good place to start hunting for the next deal if you're looking to add some healthcare companies in your portfolio.
Mhm.
So I'm not necessarily expecting a big year for them in 2025, but it's usually around those times that it's a good idea to start reading a little bit more about those companies, learning about their business model, maybe shaping your investment thesis. And if stock price keeps on going down, well, then it's probably a good time to go in. Keep in mind, those are large companies benefiting of economies of scales. It's all about repetitive purchases because, I mean, it's kind of like a sticky business. Employers do not tend to change their healthcare insurance companies every single quarter.
Hmm.
So whenever you win a contract, you're going to likely have it for a long time. So there are some solid bays for them to grow in the future, but this year it's probably going to be punctuated with a lot of volatility.
So, as you may have guessed, our first idea is United Health Group, UNH. How would you describe it, Mike?
Well, I went for one of the leader. It's the largest private health insurance provider in the US. The company is divided into two categories. So you have Optin, that is kind of like the healthcare marketplace, and then you have United Healthcare that offer our full range of health benefits. So the company is vertically integrated. They go from the insurance. They have the platform to manage all the prescriptions, and then they also provide some cares and services to the employees. They offer medical insurance, pharmacy benefits, healthcare services as a one-stop shop. I really like those kind of businesses because they are able to get some they are able to expand their margin at various stages of the business. And if there are any modification in the law, in the regulation, they are probably easy it's easier probably for them to adapt because
Hmm.
they know the service from A to Z.
And what makes it a stock to buy in 2025?
Well, I would say a pretty bad year in 2024. I mean, it was kind of like the perfect storm for them. They started the year with a cyber attack, which completely frozen their system. So it had a catastrophic impact on both employers, employees, the entire healthcare system. Of course, the company earnings were greatly affected. And then later on the year, we had the election of Trump. So now we have more uncertainties about what's going to happen with regulations around healthcare going forward in 2025. And just to make sure that it was a really bad year for United Healthcare, the CEO of their unit of their business segment, United Healthcare, got murdered right
Hmm.
after the election on another story. So, long story short, a lot of bad narratives, a lot of bad news. So, it has affected the stock price greatly, but on the other side, the overall business model has not changed. The company showed a very strong dividend triangle. So, going forward, it's probably a good moment to take a look at it and determine if there's a good deal or not.
Now, what would be the reasons to avoid it?
Well, it seems that there's a big target around UNH, and like the cyber attack, the murder story, and on top of that,
Hmm.
legislation. So a lot of uncertainties around the short term of that company. Personally, I'm not too worried. I don't have it in my portfolio, but I'm not too worried for about United Healthcare because the company has proven its ability to adapt and modify their business model according to legislation changes over the years. So, because they have
Hmm.
that expertise, I think they're going to do well. But again, it's always a risk, and it really depends on the type of risk you want to take in your portfolio. So, if you don't want to go with something that has relatively thin margin, but a company that is like virtually integrated but has to deal with a lot of regulations, well, maybe a company like UNH is not a good fit for your portfolio. On the other side, if you want to go for one of the largest company of the S&P 500 that is not a tech stock, still showing a very strong dividend triangle, and you are able to stomach those kind of risk, well, I think that UNH could be an interesting addition.
Hmm. And at this point, Mike, is UNH a core holding or an educated guess?
I would still qualify it as a core holding, in my opinion. In a sense, because it's a leader in the market. They have a sticky business. They benefit from economies of scale. Their dividend triangle, so their revenue, the earnings per share, and the dividend growth are showing very strong trend. Of course, the earnings in 2024 got a dip related to the cyber attack, but that's a one-time event. I mean, hopefully a one-time event actually. So overall, it ticked a lot of boxes. So if I had to add this one to my portfolio, I would consider it as a core holding.
All right, so moving on to the consumer discretionary sector, a well diversified one. This time, let's discuss the apparel retail industry. What makes it interesting?
Well, it's pretty rare that we talk about the apparel retail industry, actually,
Indeed.
on the podcast. Let's start a little bit broader, and then we're gonna go back to that specific industry where I've selected a company. The
Mhm,
consumer discretionary, it's all about extra spending, right? We're talking about travel and leisures, about hotels, about the car industries, about restaurants, and of course apparel industries. Last year, we saw a slowdown for many companies. Not very surprising after a few years of inflation, 2 years of higher interest rates. We have consumers that are watching their wallet a little bit more, even
mhm.
if interest rates have started to get cut in 2024, and it's likely going to continue in 2025. I don't think consumers have that much money extra to be spent. And ironically, when I looked at the comparison tool for the apparel industry, I had only four names at Dividend Stocks Rock. So the on the platform, we have this ability to identify any sector, but also any industry, and pull out
Mhm.
all the stocks in one on one page to be able to compare all the metrics all together in within minutes. So that comparison was not that hard to make, right? Because among those four companies, there was Guess and American Eagle Outfitters that didn't do that well over the past few years. So when you're thinking about more trendy companies in the apparel retail industry, of course, they're going to suffer. It's going to be a long path through growth. And there were actually two other companies, and one of them is for this podcast.
All right, and you know what, listeners? For the stock comparison tool, I'm a little upset this year because I do not plan on buying any stocks besides the one I already have, so I will not be able to use it that much.
You just have to do some
Okay.
research and prepare a buy list for the next time, Vero. At least
Yeah,
get you
I could
busy a
work on
bit,
that.
excited.
Okay, so according to the contextual economy, is this subsector more prone to success this year, or will it still face headwinds?
I don't know. What do you think? I mean, to be fair, the US economy has been a lot more resilient than I expected personally. I don't think it's bulletproof, but seriously, the American consumer did well in 2024. So maybe it's going to continue going forward in 25. But I think I prefer to go on the safer route and go into something that looks a little bit more like a discount store in that industry.
So, the idea I would like to share in the industry is TJX companies, ticker TJX. What's its business model, Mike?
So TGX is an off-price apparel and home fashion retailer. So they are selling at discount apparel and also home fashion. They own well-known brands such as TJ Maxx, Marshalls, Winners, and Home Sense. So the
Mhm.
idea is really for the consumer to get in there. They have like new arrival all the time, so it's kind of like a feeling of a treasure hunt. Similar business model than Costco has with like special products once in a while. Well, when you go into a Winners, you never know like what's going to be there this week or next week. So it encourages like consumers to come around on a weekly basis almost to find deals. And the other thing that I really like about their business model also, it's they are more flexible than companies like Guess or American Eagle Outfitters that
Mhm. Mhm.
has to go with a collection, go with a trend, and then produce a bunch of stuff, and hopefully they're going to sell it. So for
Right.
TJX, what they do is that they actually buy a part of a collection and then they put it on sale. So it's a lot easier for them, and they rarely get stuck with a high level of inventory.
And why would you add it to your portfolio this year?
Well, ironically, this company and Ross Stores, that is another competitor that is the other company in this industry, has kind of like gotten off my radar after COVID because both companies
Mhm.
had to suspend their dividend. Of course, their stores were closed, so it's kind of normal. But since then, if you look at the dividend triangle now after COVID, revenue, earnings per share, and dividend keeps on growing at a very fast pace. So they're back on track. They're actually back on what they used to be before the COVID, and I think that even if we have a recession, which has been not that clear for the U.S. In 2025, but on one side, if we have an economy that is still rolling, consumers are still going to buy more apparels, and if we get into a recession, well, it's going to even drag more people there because
Mhm.
they won't want to pay a $200 for their pair of jeans.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. But on the other hand, what should investors be aware of?
First one, competitions, because of course, when a business model works well, other retailers will take a look at it and try to see if they can copy it. Ross stores are doing a great job. Macy's is trying to become a copycat as well. So at one point, there's so many shirts and pants that you can buy in a year. So you're not necessarily going to go to Marshalls every single week all the time, so
Mm.
the growth potential may slow down at one point. The other thing as well is, while I think it would be a good selection if the economy goes sideways, the stock price has risen accordingly to the well-being of the dividend triangle. So right now the P/E ratio is at 27 times the earnings. So it's not a big, like, it's not a big bargain that you get,
Mhm.
but I think that because of the quality of the company, it still deserves your attention.
The last stock to buy for today is one that you like, Mike. It's part of the financial services sector. The industry is credit services, not banks. So, what are the key points on this one?
So wait, you're telling me I cannot talk about banks now? Like, what's that podcast? Like, what are we doing here? I mean, but actually, that was one of the reasons why I thought it was interesting to do this quick two-part series, is to tackle like industries that we don't often talk, like apparel
Mhm.
industry that never comes on the radar, and this one, credit services, is pretty much the same thing. When we're thinking about that, well, we're thinking about spending, we're thinking about consumer getting into more debt, we're thinking about debts and provision for credit losses. So those companies typically will loan money to clients. So the business model is all about managing the risk, writing the right debt to the right client to make sure that they get paid, and then you can follow the provision for credit losses to make sure that this business is not going to lend to the wrong consumers and go bankrupt. It's a classic industry to look good on prom night. What I mean by that
Mhm.
is, when the economy is rolling, as we saw over the past few years, well, as long as the consumers is getting raises and confident in the economy, he's going to get into more debt. He's going to pay those payments every month, and everybody's going to look like they're making a ton of money, and everything is smooth. However, you have to be very careful, because if, for those who have just started investing a few years ago, I suggest that you look back at the financial crisis of 2008, where there was a major credit crunch, and those kind of companies did not like their life.
Mm. So, is the credit services subsector advantage in 2025 or not?
That's a very interesting question, actually, because on the one side we have a rolling economy, a little bit of slowdown, but not too much. More resilient, as I mentioned earlier, than I thought. The interest rates are starting to get cut, so that's going to give a little bit breathing room for consumers. So maybe most of them will be great, but again, it's all about their underwriting process that is really really important. And of course, if we run into a recession, as I mentioned earlier, it depends on the type of risk you want to hold. Well, those companies
Mhm.
will make a lot of money when the economy is rolling, but when there's a recession, they're going to be the first one on the row to get hit.
So, listeners, surprise, surprise, we are not talking about Visa, but Mastercard, MA. I believe it doesn't need much introduction. So, why did you select this one, Mike?
Well, actually, there's a very good reason why we have to take a second to talk about their business model for both Visa and MasterCard. Because before I go talk a little bit more about MasterCard, is the
Mhm.
fact that while I was talking about lending money to customers and underwriting process and provision for credit losses, well, you're not going to hear those words when the CEO is talking about MasterCard or Visa, mostly because they leave all the debt to the credit card maker, so the bank. On their side, they work as a toll booth, so they are charging a fee to the merchant whenever you use your credit card. So they don't carry on the debt, they don't care about the debt. Even if it doesn't get paid, it doesn't change anything in their life. What they do is that they're just happy that you have used it. Even better, with all those credit cards with cashbacks and points and rewards, people just love to use their cards. So it's literally like a money making machine where there is like two companies operating. It's a duopoly, and it's a game of scale, network, and toll roads. So recurring revenues all the time, and they're gonna do even better when the economy is rolling because people will travel, and they're making even more money when you have currency exchange on top of just spending money. Uh, the reason why I decided to go with MasterCard instead of Visa, because when you compare both, I mean, they're identical businesses. The difference
Right.
is Visa is the leader, MasterCard is the challenger, but that's pretty much
Mhm.
it. So the reason why I decided to go with MasterCard this time is mostly because Visa right now has the DOJ on their back. They're going after antitrust law around their business practice for their debit cards, which for so far Mastercard is free to keep on working as they want, so they don't have that problem. But I do have Visa in my portfolio and not Mastercard because I prefer to have like the largest player in an industry. But that's just a preference because if you look back at the past 5 and 10 years total return performance, Mastercard has actually been the winner. I mean, both companies are great, but Mastercard seems to be a slightly better investment than the other.
But you do have a MasterCard in your wallet, though.
That's actually the card that I use the most, ironically.
All right. And what would be the risks of holding MA for investors?
Well, I would say the first thing is, and that's going to be an ongoing problem going forward, is Visa and MasterCards are getting on a lot of people's nerves. First, merchants, because they are getting stuck with big fees and they cannot really get away with it. They have to pay them because if like every single time, like I'm making a parenthesis here, but I have to make it. And I know that one of my friends is going to smile when he's listened to this, but I do have an American Express for
Mhm.
getting like points, Aeroplan points. But the problem with American Express is not all merchants are accepting it. So every single
Right.
time I'm like all excited because I'm making a big purchase and I'm like, yeah, I'm going to use this one. I'm going to make a lot of points and I'll be able to travel with it. And whenever my card get not accepted, it's not declined. It's just that, oh no, we don't take that card. Like we prefer Visa and MasterCard. I am frustrated. So imagine already, as American Express is one thing, but if someone would tell me we don't take Visa or MasterCard, I would probably just walk away and never come back to that store again. And funny story, Amazon tried to ban Visa purchases in the UK a few years ago. I think that lasted like 7 days. Like consumers went ballistic. So it's not even Visa. It was just like, okay, well, whatever. Like consumers just not going to buy on Amazon anymore.
Mhm.
So The thing is, yes, they have a very strong moat here, but on the other side, the more you get on people's nerve, the more people are going to try to find alternative and become more creative and go on innovative products or ways of transferring money. So is it going to be like their strongest mode is going to be like their weakness at one point? Maybe regulation is going to go after them eventually. We already see like one 10 attempt with the DOJ around the debit card. Mind you, those kind of stories are going to create a lot of drama. It's going to make a lot of headlines. Is it going to have a real impact? I mean, Microsoft has battled in the 2000s with antitrust laws in Europe and in the US for so many years, and still is a pretty good company today. So you never know how
Mhm.
it's going to turn out, but still it is going to make the headlines. And of course, another thing is Mastercard is kind of like a victim of its success. It will be seen as an overvalued play for, like, I don't know, like since its IPO. Actually, like, people will always tell you that Visa and Mastercard are overpriced, but I've been reading this for like the past more than 10 years now. So
Mhm.
you just have to accept that you're going to pay for quality. And in 5, 10, 20 years from now, you're probably going to be super happy that you have done it. But short term, if there's a market correction, of course, this is the type of company that will take a hit.
So in December, you pulled out 27 stock ideas for 2025 at dividendstocksrock.com. I then took 6 of them in 3 different sectors and created a free booklet for listeners. And guess what? They are not the same as the ones we share in this episode. So I invite you to download the booklet now at thedividendguyblog.com/topstocks. Between today and next week, you can get up to 12 stock ideas. That's pretty cool, right?
Yeah, enough to build an entire portfolio, actually. Jokes aside, those stocks have been selected with one thing in mind: the fact that we have been evolving in a kind of like an ever growing all time high market. So, in other
Mhm.
words, I looked at companies with very robust financial metrics. I don't think 2025 is a year to take wild guesses and trying to gamble your money. It's really a good time to buy solid businesses that will be around for decades instead of trying to buy the flavor of the month.
Again, grab your free Top Stocks booklet at thedividendguyblog.com/topstocks and hit the subscribe button so you do not miss part 2 next week. Thank you, Mike, for sharing your thoughts about these industries and dividend growth stocks. Listeners, visit our show notes for all the related content at thedividendguyblog.com/210. Until next week, stay
Stay invested.
invested.
Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.